XRP holders, buckle up, because everything just shifted in a massive way. We're talking about $7.4 trillion that could flood into crypto, and yes, the NASDAQ itself is moving in the direction of XRP. This is game-changing. Welcome back, beautiful people. Crypto Labs News. Let's jump right in, but before we do, give me that smile, send out those good vibes, smash that like button, and let's get started. So here's the headline: a mountain of $7.4 trillion is currently parked in money market funds. With the Federal Reserve signaling interest rate cuts, that cash could begin to flow into risk assets, and crypto is right in the crosshairs. Just think about it, even if a tiny fraction of that, say, 1%, moved into Bitcoin and altcoins, it could ignite one of the biggest market rallies we've ever seen. But timing is everything, and tomorrow morning at 8:30 a.m. Eastern, the PPI data is dropping. And if you've been around for a while, you know these reports can shake the markets hard. The last PPI caused a sell-off, and traders are watching closely to see if history repeats. If you're subscribed and have that bell rung, you'll never be surprised when markets pump or dump, you'll know it's tied to the latest data. That's the real edge, staying informed before the moves happen. Now let's turn to BlackRock, the biggest asset manager in the world. Their chief investment officer went on CNBC recently, and what he said reveals a lot about where institutional money is headed. He broke down today's market dynamics. Tech-driven equities are still strong, fixed income is delivering 6% yields, and private markets are worth exploring. But here's the standout: he stressed the need to hold hard assets like gold and Bitcoin as part of a balanced portfolio. When pressed on the percentage of crypto exposure, he admitted their global allocation fund is sitting at around 2 to 3% in Bitcoin and gold, with gold currently being favored as a stronger currency hedge. He even said a 5% allocation to Bitcoin feels high. But here's the thing: BlackRock is playing both sides. They're quietly keeping exposure low in their own portfolios while loudly promoting their Bitcoin ETFs to the public. Why? Because they want retail and institutions to buy their products. It's a classic example of how the big players shape the narrative to serve their own interests. This is where it gets tricky. While BlackRock pumps the message through media appearances, they're not actually overexposed themselves. That should tell you two things: first, they know how to manage risk; second, they're setting up the stage for others to pile in while they stay in control. And let's not forget, BlackRock has filed for multiple crypto-related ETFs, not just Bitcoin. So the writing is on the wall: they're building the rails for the future financial system. Now, circling back to the markets, we've seen weakness following revisions to the jobs report. That news shook investor confidence and triggered selling pressure.